What's up, everyone? David DeSell here, CEO of Model FA and your host of the Model FA podcast. And excited to bring today's guest to you, Jacob Miller, who is the co-founder of Opto Investments. And also, before we dive in, just a quick thank you to the folks over at Street Cred for putting us in touch with one another. We wouldn't be here today if it wasn't for that relationship. But with that said, Jacob, welcome to the show, dude.
Thanks. Glad to be here. And yeah, street cred is the best.
They are. They're cool and edgy, but they're also incredibly effective with what they provide. So we got a good team in our corner.
Absolutely.
So walk us through what is Opto? Like help set the stage, what you guys do, who you work with, just so for folks who haven't yet heard about you guys, they have a frame of reference going into today's conversation.
Yeah, so what we focus on at Opto is bridging the gap between private markets and the wealth community. And there's a lot of activity in this space right now, and a lot of folks, who are quote unquote democratizing private markets. But we take a really different approach. I founded this business about 4.5 years ago with Joe Lonsdale, one of the founders of Palantir, founded Adipar. And we looked out of the space and saw pretty poor technology in our sector and really misaligned incentives. An industry that had been built on the largest funds paying firms that essentially act as brokers or placement agents to raise money into their largest vehicles, using the wealth channel just as a source of distribution, not as true partners. And so we flip that on its head. We sit on the same side of the table as our clients. We are buyers on behalf of, thought partners to, fiduciaries for our partner RIA firms. And that really opened up a much broader way of building this company. If you are paid to sell, a big REIT, you're never going to build a portfolio construction engine that doesn't recommend it. It's not going to be relevant to your business if it doesn't recommend it. Because all we care about is the success of our partner firms and their end clients, we can be agnostic, which allows us to build better technology, allows us to be better partners, and to think really long term in how we approach this. And so it's not just access. Access is easy. If you just want access to private markets today, you can get it, but it's probably overpriced. It's probably not aligned with the goals of your clients. It probably doesn't differentiate your firm off the shelf. Like everyone can get access to the biggest funds. If you're trying to increase wallet share, maintain a client through a generational wealth transfer, win a new big client, showing up at the same thing as the wirehouse is not going to help you. And thinking about the next decade and what looks to be a period of higher volatility, it's also probably not going to provide a source for alpha that can protect portfolios in more volatile periods. And so we really focus on how do we make private markets work for the wealth community? Actually work for, not the wealth community for private markets. Everyone's doing that. If you listen to the earnings calls of KKR, Apollo, et cetera, they're all talking about tapping the wealth community. That's about them making more profit. We're on the other side of the table. We are making the best parts of private markets work for RIAs.
Understood. Now, do you have a typical RIA client in term, like how do you think through that? Is it the size of AUM? Like what's kind of your sweet spot? Like help frame the listeners as to if this would be relevant to them or not.
Yeah. So one of the nice things about having the best technology team is it allows you to be pretty modular. And what that means is we can work with a lot of different client types and not sacrifice on customizing their experience. This is not a round peg, square hole, take it or leave it situation. If you have a full scope that's, steps 1 through 15, we have clients in the 500 million to $1 billion range where they really need a true partner and they need steps 1 through 15. We have clients who aren't that big but work with really high net worth clientele or essentially a multifamily office model. They have existing expertise in private markets. They have managers they already work with. Maybe they want steps 1 through 5 in terms of integration, portfolio setup, construction, planning, and they want the automated subdocs and reporting and custodian integration, but they don't need the middle. At the very, we have some very large clients, Mercer Advisors, EP Wealth. How do we tackle scale issues together? You have tens of thousands of end families. you want to invest in 10 private market vehicles a year. That could be hundreds of thousands of subdocs. How do we make it a single subdoc per family? How do we make this easy to scale? And so, we work across the size and sophistication spectrum, um, and tailor the relationship to the needs. I would say, like, we don't think the best parts of private markets today are easy to access at the accredited level. There's some ways to do it. And so we tend to work with firms that have a decent concentration of qualified purchasers and qualified clients. So 2.2 overall or 1.1 with the advisor. And so if it's more of a retail business, a little less relevant today, though as regulations change, we're always seeing if there's a way to not sacrifice on quality while inviting a broader set of the population to participate.
Understood. And are you what talk to me about your service model specifically as it relates to the advisors that partner with you guys. Are they able to pull you into client meetings to help have these conversations? Do you partner and empower them to be able to have the conversations with their end client? Like, how do you actually interface beyond the technology
Yeah.
itself?
Yeah, and it's sort of all of the above. And so to spell it out a little more concretely, the primary way we work with people is creating what we call custom funds. And so if you have the model FARIA and you want a growth fund and an income fund, and maybe you have a specialty like co-invest opportunity fund, already you're going to get a lot of efficiency gain from that. You just talk to clients once a year. It's something they expect. We have tools for pacing out, like how much illiquidity can this client take? How much should I commit every year to get to my goal for that client? What mix of those one, two, or three funds is appropriate for, either which one of my model portfolios or which families? But a lot goes into that upfront building of, like, when we think about what is the Model FA growth fund. Well, let's get to know your clients really well. What's their risk tolerance? Where have they made their money? Where are they exposed? If you are a financial advisor in the Bay Area, maybe there's already a lot of implicit venture exposure. These are founders, these are VCs, these are people who maybe don't need more risk in that sector. If we're going to do growth for them, maybe that's a focus on lower middle market, traditional industries, parts of distressed and opportunistic real estate, something that's going to operate really differently than where their core income streams and existing exposures come from. And at that stage, we're partnering really deeply with whoever it is who's kind of running the investment side there, be that a CIO, be that a lead advisor. But a big part of that too is education. How do we then take that to the broader advisor community and get everyone to the point where they're not only comfortable but excited to get on the phone with clients and know that they're not going to get tripped up. You know, Often your clients might be financial professionals. You need to feel prepared going into that. And that is not just those meetings and webinars and roadshows. It's really great material creation. We do videos with our clients, with the underlying managers, and then we're always happy to get on with end clients. And that's really client by client. Do they want us as part of that relationship, or do they want us a little further in the background? We are agnostic. All we care about is, do the advisors and clients have what they need to get comfortable and excited and approach this in the right way?
Understood. So bring us back to before Opto. Uh, what were you doing? Like how
Yeah.
and lead us into Opto. Like how did that ultimately form? I think you said, and certainly correct me if I'm wrong, but you started it 4 years ago. So what did life look like beforehand?
Yeah. So prior to Opto, I was an investor at Bridgewater Associates, Ray Dalio's macro fund. It's a very large firm, but of the, my time there was probably 1,500 people. There were only about 90, 95 of us on the investment seed team. So pretty tight-knit group of macro thinkers there. Wore a few hats, worked with, big clients, and honestly, a lot of problems that individuals also face. How do I think about my future liabilities and what my assets can do? But spent a lot of my time on our rates team, focusing on risky credit, so emerging market debt and high yield fixed income. And I saw in that seat that we kept getting credit conditions right. We were pretty good at predicting what demand for capital would be, supply, how much risk there was in the market. But it mattered less and less because high yield issuance was basically just going down every year. you weren't getting the behavior you expected because of the growth of private markets. The interesting transactions, the marginal buyer and seller, the loans that were actually going to create value in the economy and change how we operate were almost exclusively happening on the private credit side. And that, both hampered our returns, but also got me obsessed with that space. And I don't know how, assuming most people are like this, like it was one thing when I was working, 90, 100-hour weeks and thought I was putting on the best trade. And it's another once you realize you're starting out in eighth place because you can't tap those markets. It's a lot harder to bring that same kind of energy. And so once that had really sunk in, it was sort of a fait accompli. I lockpicked the golden handcuffs there. Can be a little hard to leave hedge fund world, but I saw this opportunity and also saw where the world was moving towards and saw a real need to bring what Bridgewater was great at of how do you turn fundamental understanding into systematic understanding into actionable insight. Data is sparse and pretty bad in private markets. And not a lot of people have put effort into like, how does this actually fit into my portfolio? What does this look like next to equities? Like, how much should I replace this or that? And so bringing that, we call it quantamental, quantitative but fundamental insight to this growing space where there is more and more data, more and more ways to partner, I saw as this, you know, clear 10-year bet, and probably even more than that. And then it was just sort of fate. And we can talk more about fate later with one of my book choices. But as I was driving back I was living in New York at the time. I grew up in San Francisco, left the hedge fund job and was driving back across the country. Still miss that car. I bought a 2009 Jetta off the lot my first year in college. It was the cheapest car I could find in a 50-mile radius, and it was a stick shift. I didn't know how to drive stick shifts, and so luckily I went to school in Chicago, so it was pretty flat. But I
Well,
did.
I can commiserate with you. It wasn't as new as the one you just mentioned, but my first car was $1,200, and it was a Volkswagen Passat VR6.
Oh yeah,
So it
nice.
yeah, I had to shimmy the windows up because when I'd close the door, they'd fall down. So I had to
Yeah.
like push them.
Um, yeah, I was taking that car. My wife and I moved to San Francisco, and we joke about this now, but I should have taught her how to drive stick better. But that transmission blew out in about 3 days of San Francisco hills. But anyway, driving back across the country, I think it was middle of Iowa. A guy I'd overlapped with at Bridgewater for 9 or so months called me. We kept in touch a little bit. He's a great guy. He's like, "Hey, like this is out of the blue, but like I really think you should meet my boss." Like, who is he? He's like this guy, Joe Lonsdale. I'd heard of, I knew who he was. We used Palantir at Bridgewater, but I didn't like know all that much about him and didn't know that much about ABC. But it was good timing. I was, left my job and was driving back to California and got, had the opportunity to meet one of the leading entrepreneurs of the generation. And the catch was he wanted to go on a run with me the next Wednesday morning. I am a power lifter, not a runner. And so I spent that few days trying to run, speak, and not vomit. Got ready for that run meeting. We shared our thought. I was coming much more from that investment side of seeing that gap, seeing the need to apply that understanding. Joe was coming from the perspective of chairman of Adipar, seeing just how rare it was for even large firms to have a really robust and efficient access point and to get access to what he saw as like really the best parts of private markets, what he does with his family office and his smartest friends do. And so, a run turned into lunch, turned into a couple hours of the whiteboard. This was the beginning of COVID, and another kind of lucky thing, like Joe's a very busy person. He happened to not be busy because the world was shut down, and so we got to spend a
Hmm.
lot of really deep time just thinking about what this problem set was. What was the product? What was the gap? A question we always ask ourselves in venture is like, what was possible today that wasn't possible 5 years ago that makes this a good idea now? If it was possible 5 years ago and it doesn't exist, there's probably a reason.
Hmm.
But we saw the changes in the data. We saw the changes in the different pipes you could lay. And then just the change in this industry. Private markets have grown 15 times as fast as public markets. They still are dwarfed by public markets, and there's still a lot of room to run. I don't think it's a bubble. But there were a lot of reasons this was possible today and not 5 years ago. And we saw a clear gap in the market in terms of alignment, in terms of, the power had really shifted. Most institutional asset pools are at their policy maximum for private markets. They can't do more. And so if funds are going to grow, new funds are going to start, they're going to have to work with wealth. But a lot of the other players in the field haven't shown that basic respect that like the power is with the financial advisor now. You get to ask for something a lot better. You're not lucky to be let into a deal. They're lucky to have you. And so building a company around that ethos, being registered ourselves, only working with fee only, um, being built for and by fiduciaries, not sort of bolting that on as an afterthought after building for wires.
And how did you break into the RIA space, fee only specifically? Because, and certainly correct me if I'm wrong, but in your prior role, you didn't necessarily have a ton of interface with advisors. Um, so I know you guys work with Street Cred. I'm not sure if you started working with them upon launch, but there still needs to be some elbow grease,
Yeah.
applied. So how'd you guys get off the ground?
Yeah, so a few things there. One, the fact that Joe is founder and chairman at Par definitely helped. And so before we made a single hire or wrote a single line of code, I probably spoke to 80 to 100 RIAs who were at Par users, really understood what was not working today, what if we built it would be useful to them. And so had a really good group of early like user testers, feedback, got and like put in my elbow grease. That was, I was on the phone with different firms 8 to 10 hours a day, 6 days a week for 6 months before like being like, okay, here's exactly what we need to build. You want to
Hmm.
hear from the community. You also want to have your idea of it's the Henry Ford thing. Like, yeah, someone the year before the car is invented what they want. They say a faster horse, not a car. Like,
Hmm.
you need to do both. What do you want? And then based on that, how can I think 2 steps ahead and say like, you might not know this is possible, but here's where we're going. And then it was, look, this is a trust business. And so we did, start working with Street Cred right around the time we came out of Stealth, but actually got introduced to them through some early hires I made, knowing that I still had gaps in the RA side. One thing Bridgewater teaches you well is being really honest about what you're good at, what you're bad at, where you can augment yourself with the right people. And so, knowing it's a trust business, finding a handful of really top tier, I don't even call it sales, but like advisor services partnership people who had that Rolodex of firms that they had just done so well by in previous roles that they could reach back out and say, here's what I'm doing now. And we were already, 10 yards from goal. Um, and so really organic early on through those relationships, building, leveraging historical trust and people I hired had, building more trust. And, that's carried us through in addition to, working with Street Cred. But, word of mouth is really impactful. Like advisors talk, and if you can do right by people and they tell other folks in their network that they're having a good experience, that goes a long way.
100% agree. And it's interesting because one of the things that we coach our advisors is rather than trying to figure out from us or themselves on how to improve the experience that they're providing for their clients, rather than doing that, just go ask for their feedback and see what they say. So it's cool to
Yep.
hear that before you even built anything, you did a bunch of feedback sessions, essentially focus groups, if you will, to compile all the pain points that maybe you hadn't thought of yet, and then taking it a step further and say, okay, this is what they said, but here's what they'll really like. And it's still aligned, but it's better than how they were able to articulate it. So I like that you took that approach. What?
And
Oh, go ahead.
you try and look for like people say like the question behind the question. I call it like the problem behind the problem. Like someone might describe 5 problems they have, and you could tackle those piecemeal. And it's actually kind of interesting right now. A lot of options advisors have are basically to hire like 5 separate fintech vendors that do tackle them piecemeal. But if you can zoom out and say those are all because of this problem, like you have to hire those 5 firms because you share data via PDF versus API. What if I just built the API? versus hiring the this scanning service and this import service um, and that's just one example. But how do you like it is extremely active listening. You need to internalize their problems. You need to feel them like your own. But then I think in being a real technology company and we are investors. We're also a technology company. Technology is a mindset. It is a mindset of like, how do I make the problems today into things I don't think about so I can focus on the next set of things? How do we take time that advisors are spending in repetitive tasks, abstract that so they get to spend more time building their business, building trust with their clients, adding value, and you know, especially with what's happening with AI right now, it's a good opportunity to step back and say like, what are humans uniquely good at? There are a lot of things humans are uniquely good at, and that I think actually like financial advice is a AI proof industry, at least for the time being. Like I'm very bullish on being an advisor for the decades to come. And if anything, AI should allow people to lean into the most human element of this. Like wealth is very emotional. Wealth can be scary. There are ups and downs. It's a trust business. If you are spending time filling out fields in a PDF, that's not good human work. A computer can do that. If you're spending time getting to know what are someone's worries about how their estate's going to transfer, how do they want G2 and G3 to be aligned? What keeps them up at night? What excites them? How can I help them feel like their wealth is working for them? That's human value add that AI is not coming for anytime soon.
Yeah, I agree. I think the advisors won't get replaced by AI, but advisors who use AI will replace advisors who don't because they're going to be able to the 10x their output without the additional body count by leaning into AI. And even things like I feel like even just 4 months ago, the note takers that came out for our industry that were industry specific, it was like all the craze, and now it's just that's table stakes. If you don't have that, what are you doing?
Yep.
And there's going to be more and more areas of the business that force the current team who support the advisor to level up, or unfortunately, if they don't, they could be replaced, but you can grow substantially without adding additional headcount. So I agree. I think there'll be a role for a human forever, if not for a while
Yeah.
still. One of the things that I see most often, I actually just had a call with a group of clients earlier this week, and one of the initiatives that he's a part of a company. I want to say they're at like 3 billion in assets, and one of his initiatives is being more proactive and intentional with engaging the next generation. I have another client who one of his ways to do it is he put together, for lack of a better way to put it, like a financial planning 101 course to be able to share with all his clients, kids who are maybe going into college, just graduated college, as a way to just in a lightweight way, meet them where they're at and get some exposure to them and vice versa.
Yeah.
So, with that said, it's a big problem that needs to be solved. But with solving that problem, it's a massive opportunity for those who execute upon this appropriately. Walk me through how what you guys do at Opto can help with not just the retention of current clients, but the attraction of
Yeah.
those clients' kids in the next generation.
Yeah. So I'll start with kind of the most tactical and then go into some of the cooler stuff we're seeing clients do. On the tactical side, one thing we see a lot is one thing that's going to kill odds of like really retaining through generational transfers is really split wallets. And so I've got, one advisor doing this stuff and this one does more alts for me and this person does my tax. And like when that smorgasbord of vendors comes down to the next generation who doesn't have the relationships, like they're not going to maintain all of them. They might maintain none of them. If you can get to a critical threshold of wallet share for that family, and be an active part and see the whole pie and how that's going to transfer. Um, the odds of maintaining that, we've seen the data are much, much higher. And at the threshold where people are becoming QPs and above, one of the most common reasons we see for split wallets is their advisors not offering uh, exciting alternative investments. You could debate, is the stuff they're being pitched on the side and moving some money over really high quality? Like, depends. But it's exciting. And if you're like, if you're a firm who hasn't done much in that, like you're not offering that, you don't have the counterpoint. Like, do this, not that. And so by giving people a way to get to, hopefully 100% wallet share, I think you create a much better bulwark in terms of maintaining that wealth. The more exciting stuff is how do you actually engage across generations? Um, you want to know G2 and ideally G3 way in advance of that being, the do I retain this client moment. And, at the really high end, we're seeing some people do some really cool stuff. And so, we create these custom funds at the RIA level. But if a family is of sufficient wealth, you could create a family fund and say the patriarch, the two kids, and the aunts and uncle, like everyone's going to participate in some small way, or large way. And then you can start to see who in the family might actually be an active contributor. And so, like, if your granddaughter just graduated from Stanford and she's an analyst at a VC firm, what if we carve out 5% of the family fund for her to do angel investing and come back to the family every quarter and say, we're making these three investments. And she knows she has the dry powder and she can work with whoever G1 is to like what's their investment philosophy? How do I fit in what I'm doing in VC? How do I share that with the family? And so you can get people a much more active role in a safe way in industries and spaces where they might be like uniquely well suited to actually contribute to the overall family wealth picture. And even if it's not as much as that, how do you have like a really easy way for people to communicate about the most exciting things their money is doing? And so, if you're talking about like emailing out account statements and PDFs, like that's not going to excite the younger side of the family client. If you're sending, live web pages, mobile links where they can see that they invested in the next SpaceX before it was a thing, that's winning trust and giving them really cool stuff to go talk about at parties and like, but it has to be delivered where people live and cognizant of that this industry is changing and you don't just get to say like you're in the index fund. Here you go. Um, yeah. So more active engagement, more ways to engage. And private markets are inherently long term, and so it's a good chance to bring the family together and saying we're taking these 10-year bets. Here's why we're doing that. Here's that how that relates to our estate goals, our philanthropy goals, why these are aligned with our family ethos. A lot more opportunity to really align investment with either like areas where you have an unfair advantage of family. If you made your money in logistics and you find a VC who backs, AI companies in the logistics space, like you may be able to confer unfair advantages and like have a firm you own even be a potential customer to that. And all of a sudden, like you have alpha just in bringing your own expertise to bear. And so I mean, just fundamentally, it's a way to drive much higher engagement with what people's money is doing. And I think the more engaged people are across generations, the more they see the value that their advisor is adding.
I don't know if you currently track this or not, and it would likely be difficult because it would be self-reported by the firms that you work with. But I would imagine when, for a lack of a better way to put it, when you're helping a client with something sexier than index funds, they're in turn more likely to be more proactive and talk about it because maybe they have something this time that not everyone else has, like all the other index, like there's nothing to talk about if you all have the same stuff. So
Yep.
I would theorize that based on that, the advisor's referrals go up as a result of integrating this into their practice. Have you seen that? Have you heard that? Have you tracked that? What are your thoughts?
Yeah, so I mean it's just anecdotal at this point. I haven't gone across clients, but more than 5 or 6 times, we've had people say they won business because their client went and, bragged about something they were doing on the golf course at a cocktail party, and their friend reached out. Um, and so, like, that works from a business development perspective. Everyone is looking for how to differentiate. Exciting investments are a very good way to do that. And where we come in and I think can be particularly helpful is like a lot of things can sound exciting and not necessarily be the best investments in private markets. How do you bring really solid due diligence with finding very exciting opportunities and like do that in a way where it's not going to come back to bite you?
And I would imagine too, with what you offer, like it's meant for the upper echelon style client. So when they're talking about it, bragging about it, and someone reaches out as a result of that, it's not someone who has 100 grand. It's someone who has considerable wealth who is looking for something different and more exciting, as you put it.
And we've also seen that be like we get brought in a lot to join even prospecting calls with our clients when they're talking to $20 million plus clients. And being able to pull in, not just Opto team, but we could get some of our GP partners to join the call, like really show this person that by working with that advisor, they're entering a different strata. This is the investment club you want to be part of. You're going to be co-investing alongside Joe's family office, the Michael Dell family office. Like a lot of how we do our sourcing is we go out to our big backers who are we have, the Government Investment Corporation of Singapore, top VCs, but then a lot of like the top 50 family offices. And we ask them like, where did you actually put money to work in the last 3 months? What are you most excited about? We want to know that there's alignment, that this was something that they deemed like at the level where they will put money in, and then we'll ask our partners to, negotiate capacity and potentially even fees for us. And so, there's definitely that perception of like I don't want to be a part of a club that would have me, and I think that's been pretty actually true in our space over the last decade. Um, and based on our business model and how we're different than some of the platforms, we've been able to turn that on its head.
Love it. Well, Jake, one of the things that we ask all of our guests before we hop off is a book that's had an impact on them. And you chose two because you couldn't pick just one, which leads me to believe that they both had pretty big impact on you, or at least been enjoyable to read. So let's start with the first one, God, Emperor of Dune. I have not heard of that. Share with me what impact that's had on you.
Yes, that's the fourth book in the Dune series. And it gets into some pretty heady sci-fi. I'm a big fan of sci-fi overall. Like, grew up reading Dune and Asimov and everything between. I love thinking about, what various futures could look like. God Emperor of Dune is uniquely interesting. It basically this is going to make me sound like a crazy person, but there are these giant sandworms on Dune. The end of the third book, one of the characters coats himself in the larva of the sandworm and starts a 4,000 year transition into becoming a human sandworm, and is emperor of the universe for thousands of years. And most of the book takes place like in his internal monologue, but it's this. And Frank Herbert was a deep into history and sociology and just how these systems work and getting this like it's just such a bold experiment to have a character with 4,000 years of history in their head, like, and trying to communicate to the reader like what it looks like to watch society grow and evolve in that time frame and how you can try and shape and what you can't shape. And also it's just such a cool universe. But like the expansiveness of that project and how well he was able to like at least make you feel like you're actually like getting a glimpse into what that would feel like is pretty freaking cool.
Well, it's interesting. I've So I've always said, like my wife likes sci-fi stuff, so she'll go to or excuse me, pick a movie. And I'll be like, I don't really like sci-fi. Um, but you just offered a different perspective where it's I feel like it's what you said without using these exact words, is it allows your brain to be unlocked to start to theorize what the different futures, could look like. Um, it's almost like what you said when you got feedback from clients where they articulated the problem, but your job is to think two steps ahead. So I feel like a book like that allows you to keep your brain in that space of no, what not what has been done, but what could be possible. And that probably unlocks a whole nother side of your brain to think that way is kind of how I'm interpreting that.
I think that's very well put. I'm also like a student of history. Uh, that speaks to the other book we can get to in a second, but I was a classics major as well as a economics major in college. Have always been fascinated with long history. I wrote my thesis on the preconditions to war and the subsequent impact on ancient monetary policy from 3000 BC to the fall of Rome. Um, but there's a problem with history, which is you only get to run the experiment once. And so all you know is what happened. You don't know all the possible pasts. You just know the past that happened. And I like what you said, and sci-fi is almost a way of imagining, well, now we get to run some at least thought experiments. What are all the possible futures? And what would lead to them? And what do they mean? And how do you net them? And like which path do I want to go on? Um, which is kind of similar to, business building and development. Like what are the possible places I could be in 5 years, in 10 years, and 15? How do I keep an open mind and not just say like, well, if I here's my linear path, like what are all the paths and how do I think about, eventually history will be history, but forward looking, I have some choice. And it keeps your mind open to that possibility.
I love that. What about the second book, Seneca's Letters, to Lucilius?
Yeah, so was a classics major focused on ancient Rome. I like to say I got into the Roman Stoics before Silicon Valley did. It was pre-Ryan Holiday. I found it really instrumental for myself in managing my mental health, anxiety. Interestingly, a lot of the modern tools in cognitive behavioral therapy were actually directly derived from Roman Stoic spiritual and like philosophical practices. Um, and there's a difference between ancient philosophy and modern philosophy are very different. Modern philosophy is pretty impractical. It's pretty pie in the sky. It's kind of interesting, highly analytical, and also you're like, what is this? Ancient philosophy was a guidebook for how to live. How do I live the good life? What are the things I can do to thrive as a human being? Um, and Seneca's just a highly human author, and Lucilius was one of his proteges and friends, and you just get this amazing glimpse into the past. These are personal letters between them, and most of them feel like they could have been written last week. Um, and the lessons are pretty universal, um, and again, just a lot of really practical things. There's a practice of negative visualization. Spending a little bit of time every day imagining losing something that feels important to you, your job, a thing, even a loved one. And that does two things. One, it can help you emotionally prepare for the possibility of loss. So not that it's going to make it not hurt when it comes, but you haven't closed your mind to the idea that that might happen. But then it's also about appreciating what you have. If you take things for granted, you get stuck on the hedonic treadmill. Like you're like, well, I have this thing, and now I want the next thing. If you really take the time every day to say, I didn't have to be this lucky. I don't have to have the wife I do, the child I do. I think that sets you up to be a better father, husband, business partner. Like, don't take things for granted. Take a little bit of time every day to imagine what it would be like without that and reinvigorate your appreciation of what you already have. And so, yeah, that's just one example. But a lot of these practices I got a little bit crazy in college. One was about pushing the limits of comfort, and I would take walks in shorts and a t-shirt in negative 20-degree uh, weather in Chicago. Definitely did make me appreciate clothes and heating, but maybe a little bit far. But
Well, I feel you on that. Not negative 20 in shorts and a t-shirt, but I recently got a cold plunge and worked that into my routine
nice.
every morning. But out of all the examples, you said there were multiple. I'm glad that you shared the one that you did about the negative visualization because I'm big on visualizing and imagining what life will be like when X happens and what it takes to get there. But I have not implemented the negative visualization uh, situation that you just mentioned. So I'm going to weave that into my daily routine. So I'm glad you shared that one.
Yeah,
Love it.
always keep Seneca right next to me here.
Just a friendly reminder.
Yep.
There you go. Well, awesome, dude. This has been a blast. I'm excited for what you're all building. I know you've had a lot of success so far in just what probably seems like a long but short 4 years. I'm excited to see what's to come for you guys. But before we hop off, where can people find you?
You can go to optoinvest.com, search Opto Investments, or yeah, ping me on LinkedIn. I'm pretty open.
Awesome. Cool. Well, I appreciate it. Thanks again to Will and the rest of the team over at Street Cred, and we will catch you on the next episode. Take care, Jacob.
Thank you.